Oh yeah, no problem. If you have individual questions for yourself or for your group, okay, so you can email me or we can make appointment so we can meet in Zoom. Um, this week I'm going to school on Thursday and Friday for most of the time because we have the teaching conference. So if you want to maybe see me in person, we also can check out sometime. Okay, or otherwise we can always meet on Zoom because sometimes talking is more efficient than just sharing emails, especially when we have some general questions or concerns, right, regarding the assignments or other issues. So that's kind of some housekeeping. I mentioned in the beginning, so our planning, so if you see the progress, this is week 6, right? So week 6, we start on chapter 7 and we will focus on chapter 7, the lectures, demos, and probably some practice on homework and assignments. And then next week, so we primarily use it for you finish the first project and review the prior contents so we can get ready for the midterm exam on March 1st. Because I believe March 1st is week 9, right? So week 8, okay, before the spring break. So that's kind of our planning. And also in Connect, you probably already saw I post the midterm practice, so exam practice questions, which I extracted from different chapters, including concept, like multiple choice questions with concepts and short calculations. Then we have problems, and problems like ICES. Okay, so that's kind of give you a feeling for the questions, okay, like you are expecting on the exam. But I'm not really saying studying or memorize the questions, is rather than use the practice as a checkout by yourself, okay, to see maybe my weakness and which part I need to put more time to study, review my homework or other assignments, okay, so I can get ready for the exam. Chapter 7 is an important one. Okay, I can say it should be, okay, among all of the topics or chapters, this should be on one of the top, okay, always one of my top choices, because it really give you some hands-on tool you can immediately apply to lots of working environment, management situations, so cost, volume, and profit analysis. And this is based upon our understanding of the variable cost and fixed cost behavior we have learned originally from chapter 2 and get deeper on chapter 6, right? So we talk about chapter 6 briefly last week, and also we have I remember we only have 3 questions in the homework of chapter 6, kind of straightforward. I use the high-low method to separate, okay, when we have historical data, we use a high-low method to separate the mixed cost into the variable cost and the fixed cost. So given our knowledge, given our understanding on the cost behavior and the way we separate the fixed cost and the variable cost. So how we are going to apply the cost behavior in the internal analysis to help managers to predict the future and also give prescriptive guidance. Okay, means after I analyzing different scenarios or options, I probably recommend the best decision or strategy for the managers, so can use it in their operational decisions. So for cost volume profit analysis, we are trying to investigate or understand the interaction between your cost, right? So the cost will include the variable cost, fixed cost, and the volume can refer to the production volume, service volume, or the sales volume. Because sometimes the production volume may be different from the sales volume. But in most of the examples, right, so original analysis, we are assuming the volume we are talking about here, both referring to production and sales. So they are equal. Okay, means what we produced or can be sold to customers. So in that case, we can eliminate or remove the impact of inventory. So beginning inventory or ending inventory play a role in our analysis. Okay, this is the simplified situation. When we have time, when we talk about variable costing, we will dig more on the situation when the sales volume is different from the production volume. That's create some additional questions, okay, for us to address. But in chapter 7, let's just assume, okay, production equals to the sales. So that means you have no beginning and ending inventory of finished good. So the cost of goods sold normally will be the cost of goods manufactured. Okay, that's kind of the case. And certainly the profit, right? Because most for profit, like we call companies or business, are profit driven, right? So profit seeking organizations. So we are certainly investigating how, like when we change the cost levels, or you will change the volume and including the pricing levels, how those collectively will affect the profit. Okay, and we can use the profit as the criteria to seek the different options, right? So if we have different scenarios, most of the time we want to maximize, so we want to select something to maximize the profit, okay, from the different options. Okay, that's kind of, so CVP, okay, in most like business articles or in the management field, we are referring to CVP analysis or CVP graphing. Okay, graphing is mostly used for presentation dashboard, right? So give the users a quick grab master of your analysis and interactive analysis. So that's like the the title, okay, the meaning. So there is really no, in addition to a couple of formulas, right? So like the formulas we introduced, and there is really no definite ways you can analyze, because in the real business setting, the operational situations can can bring you different scenarios, right? So the one we show in the book, like the examples, we are saying we are increasing the pricing, increasing the advertisement. Those are only limited examples. So we use for teaching. But if you apply the CVP in a real business scenario, you can see really varied situations than what we talk about in class. And all of the elements or factors, so under your analysis, can be stable, can be dynamic, right? So like it's really a dynamic and over evolving situation. Okay, so when you apply it, really be flexible and use it in a relevant setting. Okay, so that's kind of the overall like the contents for the chapters. So the formulas we are going to talk about, we talk about like if you started reading, we have a very simple formula for break-even analysis, right? So how to determine the break-even point, how to determine the sales volume for target profit. And we talk about the margin of safety operating leverage. Okay, like so we have 4 or 5 like formulas, right? So you can probably understand and apply. Then there are lots of different other scenarios. So it's like when they normally when they propose, like we have proposals from different functional areas, like the production people, they want to maybe change the material, right? So like they want to change the material to more expensive one, but high quality. Or they want to cut the cost. So they recommend use lower end materials. Or they want to like use different labors, right? Also the manufacture overhead, right? The facility type of cost. So we can use more specified machineries or general machineries. So that will affect your depreciations and utility cost can play a role, right? So inflation of the prices. So and even the selling and admin expenses, right? So the advertisement, the research and the development. So every single like a factor, right? So in your under your operation can play a role and have this proposed impact on the final profit. Okay, that's your again, that's like your so rather than focus on memorizing the formulas, is really learn the approach. Again, I'm saying the approach is more critical, like this perspective to analyze the business scenarios is more important or critical just to memorize those formulas, because when you understand the story or the framework of the approach, and then you can apply it flexible to different settings. Okay, that's kind of the point. So first, contents like the topic. Before we dive in the formulas, let's take a look for a new format of income statement. I know this one probably you saw this very briefly in chapter 2, I believe. I didn't require it at that time, okay, as a required contents or putting in homework. Because the reason I don't want to add too much when we introduce the cost concepts. So I'm leaving it here, okay, too, so we can dive more after we accumulate more knowledge and understanding for different cost concepts, especially the cost behavior, because the contribution margin income statement is a direct application or focus of the variable expenses and fixed expenses. Probably I forgot I took this from our book or from my other textbook I use for my undergraduate, but I like this. You can see shoulder by shoulder comparison, right? So far, what we have focused on, especially for financial accounting, we focus on the traditional format income statement, which we have used in some of the assignments in chapter 2 or even in the job order costing system when we learn the cost flows. So we prepare the cost of goods manufactured, cost of goods sold, and as a result, we can prepare the income statement. So that time we use the income statement is the left one, which we focus on the difference between your product cost and the period cost. So this is or you can see manufacture cost and non-manufacture cost. So I just let's say, so product and this is period. Because after we learn the cost flow, we know the cost of goods sold, right? So we flow from cost of goods manufactured, and the cost of goods manufactured include your cost inputs of direct material, direct labor, and all of your overhead, manufacture overhead. So Even as external users, we don't know the detailed portion or like a breakdown of the total cost of goods sold. But for this simple case, I understand the direct manufacture cost account for exactly 0.5%, right? So 50% of your sales revenue. So it's like a 50% gross margin. So every dollar or every $100 we sell to customers, $50 cover your product cost. Okay, which you mean you see the cost attached to the products and the service directly, right? So direct manufacture or service cost. And then we we left us 6,000 gross margin. And then you need to cover other supporting expenses, right? So like supporting functions, selling element, and these days, like the research and development, okay, is part of your period cost, and also restructure cost. For example, I closed one whole division, okay, I closed my I closed a factory. So when you close a significant part of your business, there are lots of expense related to closing the segments, like laying off the employees and giving a severance package, right? So very fat package, and probably research on developing new products, right? There are lots of significant expenses related to restructuring. But anyway, these expenses are not getting into the direct production cost. Is all deducted after gross margin. So in another way, some like statement they say, oh, product cost deducted before gross margin, then period cost deduct after gross margin. Okay, that's another way to state the difference. But anyway, we end up with 1,000 net operating income, okay, before any other concerns like income tax or other operating revenue or expenses. Okay, main operating income 1,000. So traditional income statement, okay, we can get a feeling, right? Get a feeling of the breakdown of separation of product cost and period cost with gross margin in between them. Okay, so you can make assessment for the gross margin level for my company in the industry, so we can make comparisons. External. Certainly, the traditional, we majorly focus on the users of external, like investors, creditors, financial analysts, right? So from the investment companies. Now moving to, when we shift the focus to internal management. So if you are the manager, okay, think about the CEO or CFO or COO, right? So are you going to be make a decision easily with only a traditional income statement? So if I give you this piece of statement, even I give you more details, right? So material, labor, overhead, can you easily predict, okay, use the existing data to predict for your future? Okay, if I change my revenue level, if I change my expense level, how the net operating income will move or will react to my different proposals. So don't look for the right, just on the left side. So do you think, can you easily apply this in your decision-making process, especially for the changing analysis for prediction? So for example, if I'm say I increase my sales, I'm planning increase my sales, okay, next month by 10 Can I quickly tell which cost will increase and which cost will not increase, or which cost will partially change? Can you quickly get an idea of the moving of expenses so I can know how the income will turn out accordingly? Any idea? So if I increase the sales revenue, can I say, or can I assure, like make sure, if I say this, okay, how many of you agree? Okay, I will say my cost of good will increase 10% as well. If this statement is right, or if you see this in a multiple choice, is this a right statement or wrong? If my sales increase 10%, then my cost of goods sold will increase 10% as well. Right or wrong?
Right.
Right?
Right.
Right. Okay. But let's break down. So what's inside the cost of goods sold? What are the items under? So remember, right? So I just put this quickly. So we have direct material, direct labor, right? Those are always variable cost, and then variable overhead and fixed overhead. So in this case, if I want to know how the cost will react to the sales revenue, I needed to know, are they variable or fixed? The first three, they are variable. Okay, those three will increase 10%, no problem. But think about the depreciation of your equipment, the supervisor's salary, and your insurances, your property tax related to the manufacturer overhead, they probably will stay unchanged with your revenue because it's like a fixed, remember the we call committed fixed cost. So I would say this 10%, this statement is partially right because only the variable product cost will increase with the sales, but the fixed overhead will stay the same. So, but you can see if I don't really break it down into the variable and the fixed, it's very easy to confuse people, right? Especially if you are not really familiar with the accounting data or cost concepts. Similarly, on the on the period cost side, I hardly can tell whether the selling and admin will change with the 10% revenue change. And to be more clearly, only I can know for sure if I break down both of them into variable and fixed. The variable selling and admin will change proportionally, but again, the fixed one, like the overall company overhead, okay, will stay the same. So essentially, you can see the only thing change is your variable production cost and the variable selling and admin. For example, if you pay sales commission or shipping expenses, right, delivery expenses, they will increase. So when you have this like internal analysis questions, you can use the traditional, but you need to kind of transform them, right? So break down the items. So that's like why for internal managers, in addition to the external format, we give you a clear, we call contribution format income statement. So in this one, I give you a clear idea about which one will change and which one will stay the same, okay, in your different analysis scenarios. So take a look how the right one is different from the left. And the right one is actually the way, when I try to analyze, when I say, oh, I want to increase my sales by 10%, I couldn't really directly use whatever we have the structure on the left side. I need to break down them based upon the cost behaviors, and I can easily find, because the variable ones are supposed to change, but the fixed expense, they will stay the same, okay, flat. So we can quickly analyze if we, like, again, the dynamic relationships between your sales volume, pricing, cost, and profit. Okay, that's why we give the title CVP analysis. Because your final net income is a collaborative or collective result of the interaction between volume, pricing, and cost. So you can see this. So what's the nice thing about this? After sales, so we start on the same number, right? We end up with the same number, but we are going to a different procedure. The variable expense, ideally, okay, it should include the variable cost of goods sold. So be careful about here. Okay, this one they are trying to kind of simplify. It's like a merchandising. Okay, this is like a merchandising. So I'm assuming all of my cost of goods sold are variable, like your purchasing pricing. But for a manufacturer company, I would say I have the variable cost of goods sold, and I will have some fixed cost of goods sold, like my fixed overhead. Because for merchandisers, they don't have a manufacturer overhead, right? Their cost of goods sold is basically the purchasing cost, which is all variable. But for manufacturers, there will be some fixed overhead. But just the last summer, so the variable expenses will be your variable product cost, variable selling, and variable admin. Okay, most of the variable should be on the product side. Okay, most of them. And some small variable expenses on the period cost. And after this subtraction, we introduce the other important margin concept we call contribution margin, not a gross margin. Contribution margin is the difference between your sales revenue and all your variable cost expenses. So sales revenue minus all variable expenses, including both product, like variable product cost and variable period cost. And this contribution, you are referring to the income. Okay, contribution to what? How much we contribute to the company's final income, because only you have contribution margin, you can cover all of your fixed cost, like your committed. So the more contribution margin we have, then we can have more profit given the fixed cost, okay, wouldn't change, like 4,000. So the right side is more easier for managers to understand the relationships, okay, between volume, cost, pricing, and profit. But we don't give the contribution income statement to external users. They don't know this information and why. So why companies are not reporting the right one to external users also? So why they only give it to managers? So any idea? So if you release this internal income statement to the public, including your competitors, will it do benefits or harm your company, harm your operations, right? I think the damage or harm will do more than the benefits because they will know your secrets, right? So your cost structure. We talk about the cost structure in chapter 7. Those are sensitive information. So that's only for internal information, private, secrets. And even the regulators, like, they know, they need to protect the companies from disclosing their business secrets. Okay, so that's like, so this is publicly available, but this is only for internal. Questions so far? Again, okay, so rather than like I'm saying not only in addition to the formulas, one of the most important managerial accounting tool is this contribution margin income statement, because this can be used for many different business settings, especially we want to use data to analyze different projects, right? Proposals, long-term decisions, short-term decisions. So internal like performance evaluations, even budgeting. So this one is widely used in decision makings. Questions? Now let's see the different ways we can measure like the contribution margin. Okay, because this is a really important concept. Okay, there are different ways we can use like a different measurement, or it can be in whole dollars, can be in unit, or can be in percentage. Okay, so we can apply it more appropriate in different settings. This is the main company example used in chapter 7. So it's like it's a company making surfboards. Okay, surfboards, a manufacturer company, and this is like the default, the current situations. Always you can see the sales volume, sales price per unit, and the variable cost per unit. We didn't get a breakdown into the different variable items, but in real operations, you should have access to those information because we cannot focus on the overall analysis. So, we are just, using a combo item, combo variable expense and a combo fixed expense. So 300 per unit. And then when we apply it to 500 sales volume, so you can get the totals. So the contribution, we can measure the total dollar per unit, contribution margin per unit, or a contribution margin ratio. Like the gross margin ratio. The ratio can be used for comparison, evaluation, right? So more easily than the whole dollars of single per unit, especially when you compare for different products, different segments, or you compare the different periods, right? So like we can see the trend. So whole dollar per unit or percentage. But for fixed expense, we know they are a committed, right? So committed fixed cost. So normally we don't express it on per unit because the per unit is changing, right? So per unit is going down. So we normally just put it as a stable cost. So it can remind people this is a supposed to be a constant number unless you change it. Okay, unless, for example, I increase my research development, or I reduce my advertisement or other fixed expenses. So otherwise, even you change the operational setting, this number probably will not be changed. Okay. But as long as you move to your sales volume, sales price, or variable costing, the top parts, okay, the contribution margin one is a very, I'm saying like a fluctuating or dynamic one when you revise or when you have to change your, operational settings, okay, the variable parts. There is a rules of like probably you already noticed. We have a contribution margin ratio, and then we also have a variable expense ratio, and these two together is your total sales revenue. Okay, so it's here. Okay. Sometimes people didn't pay much attention to this, like when some of the simple calculations, I need my contribution margin ratio, but the question only gave me the variable expense ratio. But as long as you know, if you pay attention to this, you should know, as long as you know one of them, you should know the other one. Okay, by using 1 minus variable will be your contribution margin. Or if you use 1 minus your contribution margin ratio, that will be a variable expense ratio because together, those are your sales revenue. Okay, like in terms of the math is 100% of number one. So those are kind of the techniques, okay, especially when you try to solve some numerical questions, it
Wait,
will
what is
become.
I have a question.
Yeah, go
Dr.
ahead. Go ahead.
Where did we get this 45% for contribution margin ratio?
Oh, I'm just making example because this one, right? So you have 60% and 40%.
Yeah, that would
I'm
be
making, I'm making
okay.
another, yeah.
Was just okay.
Yeah. I'm
Okay,
just
because I see
telling
the break
you.
even. It was like, yeah, I saw the break
Right.
even. It looked like it was agreeing with what we see above, but okay,
Nice.
the last one was just example only. Okay.
Right. Yeah, for another example, right? Because for each situation, it's not always like our example, and it can be like, for example, 70 and 30. Okay, as long as them like together is becoming one. Okay, because for different type of products, you may see different combinations. So some of them you may see like 30 like a variable, but it's the 70 contribution margin. So it's all different combinations. Okay, as long as they equal to one. Oh, that should be fine. Oh, example.
Okay, I
Oh,
see.
mm.
Okay, thank you.
Okay, no problem. Oh, that's the reason again, it's especially when you do homework or some like multiple choice, or when we have asking the break-even point or some other calculations, they probably only give you the variable expense ratio, for example, 55%. They didn't give you this 45% directly, which you need in the calculation. And some people got stuck. Okay. But again, my point is we always can get the other one, or given you know one of them. Okay, this one will be 1 minus 55. Okay, you know the contribution margin ratio is 45%. This is the summary. Okay, as long we have, see the examples. Okay, we can use the total contribution margin. This one is usable, okay, mostly fits for when you analyze, for example, the total profit for 2 levels of productions, right? So I want to increase to maybe like 600 units, and how the variable cost will change, fixed cost will change. So you can compare like 2 scenarios, okay, with complete information, right? So compare different options. And unit contribution margin, mostly when we calculate the break-even sales volume, target profit sales volume, when we see the formula, okay, like you can see my point. Like for example, the break-even, I can put it here. So when you try to break even, okay, like think about any service or business, okay, especially when you try to want to be an entrepreneur, okay, in some way, how you can determine my break-even point. Okay, the formula will be the total, so the top will be your, I will just write it simply, okay, all of your total fixed expense or cost, fixed, okay, including your fixed production and fixed period, all of your fixed expense, divided by contribution margin per unit. So you can safely and firmly, right, to use your contribution margin per unit in the formula. And we only need like any contribution margin per unit equals to the sales price per unit minus the variable cost per unit. So with these 3 factors, okay, we can determine the break-even point. And the target profit is only I add whatever target profit I need in the top, and we'll convert your formula to the target profit sales, because the target profit is like additional fixed expense we need to cover, right? So in addition to the real one. Okay. So that's just add your planning target profit that will increase your sales volume beyond the break-even point. Okay, and contribution margin ratio, that can give you a quick idea especially when you don't change your fixed expense. I want to quickly find out when I change my sales revenue, how my contribution margin or net profit will change. Okay, given we have a stable fixed cost, right? So like the starting question, if I increase my sales revenue by 10%, I will know definitely my contribution margin will increase by 10% directly. And given my fixed expense won't change, my net profit will increase by 10% as well. So give you a quick way to make a prediction. Okay. And also, if you use the contribution margin ratio in the break-even formula, okay, when you use the ratio rather than the per unit in the bottom, the break-even change from unit to dollars or directly. Okay, we can find out the break-even sales revenue or target profit sales revenue. And also contribution margin ratio can be used in comparing, like comparing the contribution margin in different periods across different product lines, or even if you have knowledge, you can compare different companies, right? So if you really have those insider information, okay. So for example, I'm comparing Amazon and probably Walmart, right? Given if you have the real data, okay. Or you can make some estimation based upon what we have, Okay, so like a financial analyst, right? They because when they make investment decisions, they are picking from thousands of hundreds different investment options. They need to make certain assumptions and estimations, right? So they can compare and rank all of the businesses or companies. Okay, so they can make the right investment. Question. And so today I think I will just focus on bring up like the topic, right? So open the door like for us to get into the CVP field. Oh, but there are really like a variety of ways, in addition really to the formula. So I hope this like opening the door. Okay, you can explore all kinds of opportunities. Exciting. Okay, I like, I probably told you this in the beginning. These years, I'm getting more and more into the managerial accounting side. Okay, and also accounting information system. Okay, I like this better. I'm not really saying over. Okay, better than financial accounting. Okay, these years somehow because I really see I'm really interested in the real world applications. Even I'm not really working in the industry. But daily, I subscribed to the Wall Street Journal, the online version, and a couple of other resources like the CPA journal, strategic finance, okay, which is a publication from the internal management institution. Okay, their monthly publication. So I'm really following, so to see really what's happening in the real world, because I really see frequent the connections between the materials I'm teaching, because as a professor I'm not really only wanting to teach you this fake or make up examples or write the formulas like the series. I really want to like, especially for graduate study, right? That's the reason I give you some like real world projects. Okay, so apply your knowledge into like the ABC, right? So it's easier to do the homework, much easier than really analyzing a real ABC application. So I believe you are all serious learners, right? So you are not only trying to memorize the formulas, you try to use whatever you gain from, the MBA program, so you can, escalate your career opportunities, open, right, widely to all sorts of opportunities in the future, or even enhance whatever my current position, right? So that's kind of like my, perspective, okay, as well. So CVP, okay, like after we learn the basics, so what are the other applications? We can use it for internal, like profit analysis for segment performance. The segment can be based upon the geographical locations. So for example, you compare your, we have different tiers of markets, right? So like European, like Asia, like North America, South America, African markets, right? So you have the large geographical segments. Then underneath, you have the country level of data. And after country, you may have regional, right? Then regional, then local, and then shops, right? So that's kind of like, we use the contribution margin with adjustment. We call segment margin, okay, or you can call segment contribution margin, okay, rather than the traditional income format. And when we make a budgeting, like prediction, like for cost and expenses, how we can make accurate and relevant predictions. There are so many hundreds of thousands expense items. Now, again, you can see we can use the separation of variable cost and fixed cost, and even ABC application like activity-driven expense management analysis, okay, in making the budgets more relevant. Because lots of, I believe, even in the top companies these days, because I talked to a friend, she worked in the HR department of Chevron headquarters. She's kind of a expense, what do they call, like a data analytic, like a specialized manager or something. So she focuses on analyzing the budgets and expenses for the HR related project, for example, employee trainings. Because Chevron, the second largest oil company, right? They have lots of other activities under their HR rather than like what we imagine, only hiring people, lay off people, or training people. They have much more other activities, and they have a large budget. Okay, so divisional managers and office managers. So my friend is in charge of checking the budgets they reported, so by the different activities and the projects, and go over those budgets and to see where they can save money, because her boss normally give her, okay, 20% cut or 8% cut, okay, for next year. Then she need to squeeze this 8% from all of the expenses she's managing or, supervising. So I asking, oh, what kind of tools or techniques you used for analyzing which expense is reasonable and which one you need to cut off? And she said just sometimes by her feeling, or it's like because the managers, okay, the divisional managers, they try to build a lot of slack, budgetary slack. They try to put too much. So she said, I just say, okay, 4% for every item. Okay, you need to cut off, or 5%. So you can see in the real business, like, I don't really think the application is so, like, especially the traditional, functions. There are lots of you can do, okay, to, what I say, like, to refine your operational analysis. Okay, even for this fundamental management, like managerial accounting or general management tools, it's surprising to see how hardly or how rarely or how in a smaller scale they are applied, okay, to benefit the operations. Because for oil company, as we all know, historically is a fat business, right? So it's a fat business. They have lots of profits and cash. Sometimes they don't really care much about the expense. They have money, but it wouldn't all be like this way in the future. All right, during the COVID 3 years, they had a hard time. And you never know when the next, the down cycle will happen. So I'm just like, dragging this a little bit. Okay, so budgeting, when we have time later to talk about it, okay, is another challenging ongoing issue in the management. Okay, not only for accounting, this is a general management challenge. You have it, but how useful the data is and how the budgeting will benefit the operation rather than damage the incentive of your employees. Okay. There is really ongoing debates. And finally, lots of special decision making, like customize the pricing, make or buy choices, closing or opening a new product. Okay, we all can apply this contribution margin in a variety of settings. So that's after chapter 7, after spring break, after the midterm, I will bring the special decision to the next topic. Okay, then we'll probably check in the segment performance, target pricing, and budgeting topics later. Questions? I have a chat.
For the midterm, you said it's on March 1st. Is that in person or is it online?
Is March 4th.
Oh, 4th.
Yeah,
Okay.
yeah, that's in the syllabus, in the calendar.
Oh, okay. I misheard you. My bad.
Okay, no problem. And Larderic mentioned you don't have a group. I send out all of the group information separately. So you mean there is no response from your group members, or you haven't got connected yet?
I actually have a question about the groups. Were you gonna assign us to a group, or did we have to go ahead and pick our own groups?
I already did.
Okay, could you let me know where in Blackboard I can find it? Because I think I'm still in the group that we
I
created.
post a spreadsheet having all of the group information, and also I send each group individual emails. Like
Okay.
I normally have a 4-people group. I send out like the 4 people's using your I think your banner TSU email. But if you can't find it, email me separately. Okay, I can resend you the information. Because there are 5 group, they found their own group, so I just follow them, and for the rest, like almost half. So for the rest, 5 groups, I assigned just following the alphabet. But I didn't really check your schedule, but I send the information to each group. Any other questions?
I'm sorry, my Wi-Fi keeps going in and out, so I keep disconnecting.
Oh, no problem.
Could you let me know in Blackboard where I can find the groups? Because I'm still in my
I think I have an announcement. Check the announcement. If it's not last week, then should be the week before. I have an announcement and with a Excel spreadsheet. It should reach your email as well, but can you hold on, and I can let you know maybe in 10 minutes once we finish this lecture. If you still cannot find it, I can show you. Then I think let's probably just bring the break-even analysis. Okay, then we are done for today. We already did the formula, because the formula in the beginning you think, oh, this is something new, I need to memorize. But after some time, it's really become a as long as you understand, like I'm saying, there's even no need to memorize. So let's go back to here. So this is our current. Okay, let me eliminate what I just marked. So make it this, especially this. Let's take a look the total part. Okay, the total situation, the current, we have 500, right? So we are making 20,000 profit. So let me quickly ask you a question. So based upon the information here, can you quickly find out what's our break even? So let's not talk about the formula, just use your intuitive sense. Can I quickly find out? So right now it's 500, right? So we are making money. Certainly the break even will be below 500, but what point is exactly? Can I have a quick way to find out without using whatever formula?
Is it
Remember,
the fixed expenses divided by the contribution margin per unit?
exactly, but why? Okay, why the formula is like that way? Because you can see like we said, right? So this makes sense. So for you to break even, remember, break even, we need to first cover all of your fixed expense, right? So think about when you open a new business, you set up 80,000 in the upfront, right? So my, renting the office, hiring the people, buying the equipment. So I already spent 80,000. Then I start to sell my products or provide a service. Each unit brings me $200 of contribution margin, right? So one unit give me 200, 2 unit, 400, 3 unit, 600. Or if you do service, similar. Then the question becomes, how many units I sell, right? So each unit bring me 200. How many units I needed to sell to reach or cover this 80,000 fixed expense? Did you see the X will be my break even? And that's why the formula is like this. So I said, okay, even no memorizing, as long as you understand your contribution margin income statement, you can get your own formula. Make sense? And the calculation is easy here, 400. So that's why per unit contribution margin help us quickly identify the break-even point. So it's 100 below our current sales, right? So after break-even, so the first 400, you can see when you sell, make and sell 500, we can think about there are two groups of sales. The first 400 help me cover the fixed expense. And then for the next 100 is bring me profit. Okay, each one bring me 200 because this one covered the fixed expense and each one bring me 200. You can see, without even doing this statement, I can tell my net income is 20,000. Why? Right? So first 400 covered this. So amount is all the 100,000. Okay. First 400, if we can order, okay, if we can have a sequence. So 80,000, then leave me 20,000 as profits. Then let me give you another number. Can you quickly find out? How about if I increase my sales to 600 units? How quickly you can find out the new net income? I increase my sale to 600 total surfboards. How much the net income will be? Anyone? Keep in mind, 400 is break even. After break even, it's become profit.
It-
So, yes, go ahead.
40,000, just additional 100. So it's already 20,000 for an additional 100.
I
So
didn't
you're just
see.
bumping up another 100.
So Sienna, right?
Yeah.
Yeah, you should change your question tone to affirmation. Yes, you are right. Yeah, so you are right. Yes. Yeah, because that's really, you probably think, oh, isn't this easy? Right? So isn't this easy? Like,
I was about to do
yeah,
a
right.
calculation, but then I was like,
Yeah.
well, it only went up by 100. So
Right,
you already
right.
gave us what it
That's
is.
really true. Yeah, because rather than have 100 extra units, we have 200 here. Or you can say I add another 100. Right? There are different ways we can found out. But if I can do directly, this is 200 by 200, right? So the new, it will double what we have right now. So if you increase your sales by 100 units, right, and your net income will double, right? So a small, not really that large increase on sales will double your net income. Okay, that's why that's kind of the operating leverage. Okay, you have like leverage using to because of the cost structure, so we can have a higher income change than the revenue change. Okay, we'll dig that topic in the end of this chapter. But this give you idea. You probably don't believe how easy it will become for me to make predictions. But I'm giving you some like simple like situation. So we in the beginning, okay, we understand this, dynamic, okay, changing. But in the real situation, it won't come so easy, right? So where this 600 or additional 100 can come, for example, I need to maybe lower my price a little bit, right? So probably I need to, for example, I need to reduce to 480 for us to have 600 units sold. Or I need to maybe increase 1,000 advertisement. Or I can do other things. For example, I increase the quality of my materials, right? That will increase my variable cost, so I can boost my sales. Okay, there are different ways you can boost your revenue, but are they all viable choices? Okay, are they going to give you higher net income than your current situations? Some of them will, but some of them won't, okay, as contrary to our expectations. So that's when the analysis will be needed, okay, will kick in later. But in the beginning, we are using some simple cases so we can truly understand, okay, why we say the contribution margin is such a useful concept for managers to understand and apply in their, operational, like activities on daily basis, okay, because each day you are dealing with ideas, right? So proposals and market change, I have to react. So how I'm going to react to the market change. For example, we have a stable sales, or we have a material price increase, inflation going on. I want to keep my income stable, right? Stable income. So what I can manipulate or maneuver, navigate all of the changes. Okay, so we can keep a satisfying result of the operations. Okay, that's kind of the things. And again, if you want to quickly, okay, I'm just bring this and then we'll really stop. So if you want to add a target profit, okay, to your estimations, so you can see we only, this is the margin, okay, we can get the dollars. This one, so I think unit here, not a margin. Okay, there's something I need to change. Per unit. Okay. Oh no, I'm right. I'm thinking ratio. Okay, so still. Yeah, unit contribution margin. Okay, when I want to add a 100,000 target profit, this is a lot, right? Because right now is only 20,000. So when I want a big fat profit, you can see, okay, even my ambition, right? So ambition or dream, right? So how many products I need to sold, okay, to reach this goal? Yeah, more than doubled, almost double. Okay, right now it's 500. Do I really have a room, right, to work the sales from 500 to 900? Maybe it's not like a short goal, but maybe a long term or mid-term goal, right? So that's my target profit, right? So once you understand the break even, the target profit follow the same suit. Okay, just adding whatever you are planning to do. So I think I will stop here the slide is already in Blackboard. Okay, under which week, but I should be like it has a title chapter 7 and with some other resources like a video, like the YouTube videos and plus some other maybe homework examples, I believe, right? So for chapter 7. So I will stop here on Thursday. We continue. Probably we can finish the whole thing. Okay, if we couldn't, but anyway, like we don't really have new topics before the midterm. Okay, that's pretty much about it. So chapter 7, and I hope every group can finish your first project strongly. Okay, before kind of the midterm. Okay, before the spring break, and then after the midterm, the spring break, we get more on the CVP special decisions, and so like on the prediction side. Okay, I think I will stop recording and